Nick Colas is joining, the co-founder at DataTrek Research. Nick, it's great to see you in a time of need because I've got a lot of questions about this market, Nick. Firstly, when we've got the shift now with bonds selling off, as we were just discussing, it's hard not to question, how quickly this can happen and unwind until it starts to weigh on the narrative we've had for stocks, which is, cuts, slower economy, growth companies. Is it premature to worry about a bond sell-off at this point?
I think it is. We had a tremendous rally in bonds. And if you look back at history, it's one of the bigger rallies of the last 30 years. And so we should expect some pullback. There's been a lot of fears in the market about recession and slowing in global trade, and those have been rational. But we're basically coming off of way overbought levels. And so I'm not concerned for the near term that a rate move back to, say, 2% derails a stock market rally.
Okay, when we've got this sharp move, if we look at, say, the 10-year yield on a 5-year chart, guys, if we bring it up, it's starting to, again, remind me, Nick, of when we came out of this malaise from 15 to 16. The 10-year yield came back. You were able to unwind a lot of the bond proxies in such a way that didn't disrupt the market as a whole. But when I look at the nature of the stock market today, a lot of the high valuation companies now are the utilities, real estate, SPLV, the low vol factor is now like blended with momentum. It's up 25%. So if the bond market has a quick trajectory in yield upwards, like we saw coming out of that in 16, are there certain parts of the market, though, that are going to be exposed?
Yeah, on the downside, you certainly have seen rotation out of tech, out of min-vol, out of momentum. That's because particularly momentum, is very heavily tech-focused. The min-vol MTUM ETF is 39% technology. Mm-hmm. So you have to understand that some of these funds are also very exposed to one sector. The big winner has been financials, and that's going to continue if yields continue to back up, more because European financials were so beaten up. They got destroyed this year, and now they've begun to rally. And they're taking U.S. financials along in their wake, and that really helps the value trade. If you look at S&P value, financials are the biggest part of that group, so that naturally helps that space.
Nick, is there still the potential, not even the potential, I guess the point is when we've had such a strong trend, is the likelihood still that we need to be more concerned about economic slowness as opposed to a quick reversal that might be caused by, inflationary components or a bottoming of the global economies? Because we still have, obviously, this market that has been very, very deeply concerned about recession.
We should still be concerned about recession. Now, the U.S. is pretty good, and we've seen some good consumer numbers, and Q3 GDP should be about 2%. That's slower than the last 4 quarters of 2.8, but still okay. We have to be worried about Europe and the European economy because they're so reliant on trade with China that any slowing in China directly affects Europe, and that's the real Achilles heel in this market. That's why this reversal in European financials has been so important for global equity sentiment.
Now, what does that mean to you, Nick? Because as we're looking at your chart here, just that Treasury spread, we know the yield curve inversion was put on everybody's map. What do you can we kind of understand where the bond market goes? Do we know how this unwinds, though, if a deep, deep concern about global recession was wrong? Because, again, we've never really had this where the yield curve inverts and there's a possibility that maybe it was a false reading, right? This is still kind of an uncharted area, even if it is good news.
Yeah, no, you're right. Look, we still have to be concerned, and the chief concern is U.S.-China trade. The way the U.S. equity market traded in the last month, correlations went through the roof. Sector correlations averaged 0.7, the third highest reading since President Trump was elected. And it tells me that the market's really focused on this U.S.-China trade issue because it's certainly not rates, it's not the Fed policy. It is purely because of this concern. If U.S.-China trade gets resolved, partially or in full, in the next 3 to 6 months, global economy is okay for next year. Equities are great to own. If it doesn't, this market's got real problems because the market knows we're really on the bubble right here. It could break either way, and it has to break towards U.S.-China trade getting resolved. Otherwise, all bets are off. You get a recession next year, no doubt in my mind.
So, Nick, this is where I still kind of come back to this catch-22. It's hard for me to kind of get past this logic where if the economic risk escalates, then we're dealing with possible, recessionary situations. And to your point, I think it's a good reminder that what we've experienced is basically so far a blip, right, among a very strong trend. But at the same time, if on one end, worsening economy means possible recession, on the other end, we saw the past week just the rumor and the thought of a meeting between the U.S. and China sent, 2-year yields for one of the biggest sell-offs since 2010. Is there also some kind of positioning risk if both stocks, bonds, and gold have all been kind of expecting central banks to have big programs to save the economy?
Yeah, you're right. I mean, there's a problem. The basic problem you're outlining is timing, because these things have sort of uncertain trajectories. If we do get a global slowing of the economy and a recession, then corporate earnings expectations are way too high for U.S. equities. Markets right now expect the S&P to earn about $160 a share this year, $160 next year. You get a typical recession, you can cut 20% off those earnings. And so stocks are clearly not the place to be. Bonds are going to be your safety trade, and gold is probably going to do extremely well because of those worries about what central banks have to do to fight a recession caused by trade wars.
Nick, when you talk about correlations, I think it's important too. You see that the 10-year, the long-dated treasuries, 20-plus years in stocks, the correlation hit -6.6 over the last month. You call that a remarkable reading. Tell me about that.
Yeah, bonds are always a good hedge, right? And we own bonds always in a portfolio because they're a hedge against our stock positions, and that's fine. They worked extremely well. That 0.66 negative reading is the highest number we've seen in years, which means bonds did a fantastic job of hedging, and anybody who has a portfolio with both knows that. However, we have to understand that that's about as good as it gets, and you're not going to have the same kind of hedge because of the uncertainties that you raised going forward. So enjoy those gains, but understand Treasury's in a really strange spot right now.
And this is, I think, important too, as we were talking at the top of the show here. Obviously, the correlation between stocks and bonds, from a very sort of just 30,000-foot view, they went up together. They have been going up together for the the entirety of the bull market, basically. If the 10-year bottomed out, Nick, what does it mean for that correlation? I mean, is there continuing to be a comfort here where, look, bonds and stocks maybe can handle a little bit of a drop in their correlation without being hugely problematic for investors?
Yeah, absolutely. Like I said, last month was just a fantastic month for diversification between stocks and bonds. It'll still be fine because that's the nature of the two asset classes. It just won't be as good. So, don't expect treasuries to be up 20% next year like they were over the last 12 months, long-dated treasuries, simply because, you're working off a different base.
Nick, you're a former equity analyst. You guys do a lot of good sector work at DataTrek. I'm curious, in the past week, have you guys looked at what people are buying in this so-called value rotation? Is this stuff good value, or is it, L brands, and is it GameStop, and is it companies that are having, bad charts, bad, price action for a reason? Is the value stuff here people are picking up good? I mean, is it just, look, banks or what?
It's 50-50. Look, there's been a dash for trash in the last couple of days, and that's absolutely the case. And that always happens off of a bottom, and that's fine. Those are always good trades. The fundamental thing has been financials. It's the cheapest group in the S&P by a long shot. It's like 11 times earnings. S&P is 16. And as I said earlier, it was buoyed by this reversal in European treasuries. A month ago, every bear on the street here in New York was talking about European financials going to zero. They're up 10% over the last 3 weeks. They've had a reprieve. It's helped financials here in the U.S. as well. That's been the real focus of the value trade.
Do you need big follow-through on the economy for banks to keep the run going, Nick? Last point here.
Yeah, you probably do. You do need to see a plus 2% Q3 GDP print. You need to see U.S.-China trade give us some confidence about 2% growth next year, and the 10-year to get back well over 2 to keep this financials rally going.
All right. I like it. Nick Colas, dash for trash, part of it here, I think is what I heard. I like that. Nick, great work as always. Pleasure to have you here, Mr. Colas. Appreciate it. Nick is the co-founder at DataTrek Research. Awesome stuff.